Welcome to the podcast Black Token for this Monday, March 25, 2026. In this space for conversation and reflection, we explore current global events together, the stories you need to know. You can support this project via PayPal or through crypto by leaving a contribution in Bitcoin, Ethereum, or, if you prefer, Solana, now enabled. You can find the links and addresses in the description. Find US on your favorite platform, Spotify, Amazon Music, Apple Podcasts, TuneIn Radio, or YouTube. We are on almost every platform. Share our podcast with your friends. So imagine knowing the future just 15 minutes before everyone else does.
15 minutes in your daily life is, what, a quick coffee break?
Yeah, exactly. It's the time it takes to, reply to a few emails or scroll your feed.
Right. But in the architecture of modern global finance, 15 minutes of advance notice is, well, it's enough time to legally extract $500 million from the global economy.
$500 million. It's just nuts. And today, we are tracing exactly how that happened, and honestly, more importantly, how the mechanics behind that massive wealth transfer are connected to everything else happening on the geopolitical stage.
That is the core of what we're unpacking today, because we're looking at a landscape where the traditional boundaries between, say, a military maneuver, a Wall Street algorithm, and artificial intelligence, they just don't exist anymore.
They're completely blurred.
Exactly. They are all part of the same complex machine. So if you are listening to this right now, the stakes for you are incredibly high. Whether you're holding a few digital assets in a cold wallet, or you're monitoring how international oil supply chains affect your business costs, or even just trying to secure your digital identity against autonomous software, the ground rules are shifting.
Right. And if you don't understand the underlying mechanics, the actual why and the how behind these headlines, you are effectively flying blind in a hurricane.
You really are.
So to understand these mechanics, we kind of have to start at the exact point where geopolitical warfare just slams into financial market liquidity. Because our sources are pointing to a scenario where macro policy decisions regarding international conflict are creating these massive, hyper-concentrated windfalls.
Yeah, we're talking about the current situation in the Middle East.
Exactly. We are now entering the fourth week of the direct conflict between Israel and Iran. And, the escalation isn't just rhetoric anymore. Our sources detail specific recent strikes directed at government infrastructure right in Tehran.
Right, and in response to this deteriorating security environment, the United States has actually deployed 2,000 additional troops to the region.
Which brings the total recent reinforcements up to, 7,000 personnel?
7,000, yeah. And to understand the gravity of that, you really need to look at the logistics, not just the raw numbers. Moving 7,000 United States military personnel is not like booking commercial flights.
No, I imagine it's a logistical nightmare.
It's a massive mobilization. You're talking about armored assets, air defense batteries, signal intelligence apparatus. It's a posture that signals severe, immediate readiness for a wider conflict. It telegraphs to the global markets that the risk of regional contagion is incredibly high.
And while this immense military hardware is moving into position, the diplomatic gears have just ground to an absolute shuddering halt.
Total standstill.
Which brings us to the negotiations, or, the lack thereof. According to reports we're reviewing, Pakistan has stepped forward, offering to host a diplomatic summit based on a 15-point de-escalation plan drafted by the United States.
Right.
But Iran has responded with a set of maximalist demands. And when you look at these demands, they seem fundamentally designed to just be rejected right out of the gate.
Oh, absolutely. They're asking for the total closure of all United States military bases in the Gulf region.
Which is never going to happen.
Never. Furthermore, they want to establish a framework that would allow Iran to collect shipping fees, which is essentially a toll on all vessels passing through the Strait of Hormuz.
Wow. Yeah, and they're also demanding the immediate lifting of all international sanctions, an end to operations against Hezbollah, and a flat refusal to even allow their ballistic missile program on the agenda.
Let's break down the mechanics of that Strait of Hormuz demand, because that seems like the linchpin here.
It is the linchpin. The Strait of Hormuz is a geographical choke point. It's this narrow strip of water, and roughly 20% of the entire globe's liquid petroleum supply passes through it daily.
20%.
20%. So if a sovereign nation dictates a toll there, they aren't just collecting transit fees, they are seizing a valve that controls global inflation.
Right, because if shipping companies have to pay a toll, their insurance premiums just skyrocket.
Exactly. Freight costs double, and the price of literally every manufactured good and gallon of gas globally ticks upward. So United States officials view these demands not as a starting point for negotiation, but basically as an assertion of total regional dominance. So we have this massive military buildup, a diplomatic stalemate, and the threat of a massive shock to global energy supplies. Naturally, oil prices would be highly volatile in this environment. But here is where the narrative shifts from geopolitics to high finance.
This is the crazy part.
It is. Our sources highlight an incredibly anomalous event in the commodities market that occurred precisely around a major de-escalation announcement. The President of the United States posted an official statement on the Truth Social platform declaring a total suspension of attacks on Iranian energy infrastructure.
And from a market perspective, that post is a massive pressure release valve. I mean, if energy infrastructure is removed from the target list, the immediate existential threat to the global oil supply just evaporates. Basic supply and demand mechanics dictate that when the threat to future supply decreases so abruptly, the spot price of the commodity should plummet, and it did.
But the anomaly we are tracking isn't the price drop itself. The anomaly is the timing of the capital deployment. According to the trading data, in the exact 15-minute window before that Truth Social post went live and became public knowledge, exactly 6,000 highly unusual options trades were executed.
6,000?
Yeah, and these trades represented a staggering $500 million bet that oil prices were about to crash.
We really need to explain how a trade of this magnitude actually functions, because dropping $500 million into the market in 15 minutes is, well, it's a logistical nightmare if you don't know exactly what you're doing.
Right, walk us through it.
So in the options market, you are buying contracts. A put option specifically gives you the right to sell an asset at a specific price before a specific date. If the market price crashes below your strike price, the value of your put option explodes.
Okay, that makes sense.
But to acquire 6,000 of these specific, highly leveraged contracts in just 15 minutes without tipping off the broader market, that requires incredibly sophisticated execution. You are essentially sweeping the order book, silently absorbing all the risk that market makers are willing to sell you moments before the fundamental reality of the asset changes.
And a 15-minute runway might sound like nothing to a person walking down the street, but to a high-frequency trading algorithm, 15 minutes is an absolute eternity, isn't it?
It's an eternity. It's more than enough time to parse the data, check liquidity pools across multiple exchanges, and execute thousands of microtransactions to build that massive position. Modern financial algorithms operate in microseconds.
Right.
So a 15-minute window is practically glacial for institutional trading. If a coordinated entity possessed advanced knowledge that a major market-moving announcement was imminent, 15 minutes is more than enough time to deploy capital, construct a massive short position, and just sit back.
And wait for the post.
Exactly. The moment the announcement hits the public wire, the rest of the market reacts, the algorithms driving institutional portfolios dump oil futures, the price crashes, and that $500 million position instantly becomes a historic windfall.
Before we go any further down this path, I need to pause and issue a very strict mandatory disclaimer to you, the listener. In this segment, we are analyzing reports of politically charged actions, specifically involving the current United States administration, military movements in the Middle East, and resulting financial market activities. We want to be absolutely clear. We are not endorsing any viewpoints, neither left-wing nor right-wing. We are simply reporting the ideas, the data, and the market movements exactly as they are contained in the original source material.
And that neutrality is vital because the patterns in the data are what we're actually analyzing, not the politics. If we look at the historical context provided in the sources, there's a direct parallel drawn to the year 2018.
Oh, during the trade negotiations.
Right. During that period of highly volatile trade negotiations, analysts observed very similar footprints. Incredibly lucrative, perfectly timed options trades executed just minutes before major tariff announcements were made public.
So the structural suspicion is always information leakage.
Always. The core difficulty for regulatory bodies like the SEC or the CFTC is proving the chain of custody of that information. Finding the exact digital fingerprint that connects a policy decision in a closed room to an options trade clearinghouse is notoriously difficult.
So if I am a retail investor listening to this, processing the fact that $500 million just moved based on a 15-minute head start. How am I supposed to view the market?
It's tough.
It feels like sitting down at a high-stakes poker table where the VIPs have a mirror behind the dealer.
Yeah.
You're playing probability, but they're playing certainty. How do you navigate a market where the geopolitical house is allegedly trading on its own policy decisions?
It forces you to completely reevaluate your strategy. As the retail participant, you have to internalize the concept of information asymmetry. You are basically at the absolute bottom of the information food chain.
Yeah.
The market will always price in rumors, leaks, and institutional data long before it reaches your newsfeed. When you see a massive spike in unusual options activity, you're looking at the exhaust fumes of institutional knowledge. The takeaway is that you cannot beat them at the short-term, event-driven trading game. You lack the speed, the access, and the capital.
So what's the alternative?
Retail survival depends on stepping out of that arena entirely and focusing on long-term structural economic trends that are too massive to be manipulated by a single leak or a social media post.
And speaking of structural economic trends, when insiders extract massive amounts of capital through geopolitical volatility, that pressure doesn't just vanish, it compresses the global economy. When energy markets are weaponized and manipulated, the first things to break aren't the trading desks in New York.
No, definitely not.
It is the fragile infrastructure in developing nations. That brings us to our sources' deep dive into Latin America, where we are seeing severe economic collapse and the implementation of extreme, unprecedented legal measures.
The physical ramifications of macro financial games are always felt first at the edges of the global economy. A spike in energy costs or a collapse in a local fiat currency immediately threatens basic societal functions.
Let's look at the electrical grid in Cuba as a prime example of this systemic breaking point. Our sources detail an energy crisis that has reached a state of functional collapse. The island is currently experiencing 15-hour daily blackouts.
15 hours?
Yeah, and this isn't just an inconvenience. A 15-hour blackout means cold supply chains for food and medicine completely break down. Water pumps stop working. The baseload generation capacity of their grid has essentially failed. And economic experts in our sources estimate it would require an immediate injection of $8 to $10 billion just to stabilize the infrastructure.
And then you look at Venezuela, which is experiencing its third massive wave of protests just this year. And we really have to look at the exact economic mechanics driving those protests. It is pure systemic desperation. According to the data we have, the official minimum wage in Venezuela is frozen at the equivalent of 28 United States cents per month.
I want to pause on that number so you can truly absorb it. 28 cents. For an entire month of labor.
Yeah.
It defies comprehension. How does a human being, let alone an entire economy, function on 28 cents a month?
It functions through the total deterioration of formal labor laws. The only way companies operate and the only way people buy a single loaf of bread is through an informal loophole. Employers bypass the official minimum wage entirely by paying their workers in what are classified as bonuses.
Because these are legally categorized as bonuses and not salary, they're non-liable.
Exactly, meaning the employer doesn't have to pay Social Security, pension contributions, or severance based on that money. It completely hollows out the concept of a safety net. The worker receives enough parallel currency or digital dollars to survive the week, but they accumulate absolutely zero financial security, no vacation pay, and no legal labor protections. It is the architectural dismantling of the working class, forcing an entire population into a permanent state of day-to-day gig survival.
And when an economy is dismantled to that cellular level, you witness massive, desperate human migration. People flee, which leads directly into a highly complex international legal battle highlighted in our sources. There is currently a lawsuit filed in the United States District Court for the District of Columbia. The plaintiff is Nayarver Adrian Leon Rangel, a 28-year-old Venezuelan national, and he is suing the United States government for $1.3 million.
This specific lawsuit is a fascinating intersection of international border policy, the privatization of incarceration, and sovereign jurisdictional rights. It really reveals the hidden financial plumbing of immigration enforcement.
Let's walk through the timeline. According to his filing, Leon Rangel was residing in the United States until March of 2025 when he was expelled. The United States government accused him of being an active member of the Trinidad transnational gang.
Right.
Now, Leon Rangel categorically denies this affiliation. In his lawsuit, he states his only encounters with the law were a minor arrest in Texas for drug paraphernalia, which he claims he successfully proved did not belong to him, and the fact that he has a large artistic tattoo on his left hand, which authorities allegedly profiled as a gang marker.
But the critical mechanism here is what the United States did next.
Yes, they did not deport him back to Venezuela. Instead, they placed him on a flight and sent him directly to El Salvador's maximum security mega prison, known as CICOT.
And for context, CICOT stands for the Center for the Confinement of Terrorism. It is arguably the most secure, densely populated carceral facility in the hemisphere, built specifically by the Salvadoran government to house tens of thousands of suspected gang members under permanent martial law-style conditions.
Right. And Leon Rengel claims he was held in this facility until July of 2025, when he was abruptly released as part of a broader geopolitical prisoner swap negotiated between the United States and Venezuela. His lawsuit details harrowing conditions during those 4 months. He alleges he was routinely subjected to severe physical beatings by the facility guards, intentionally starved, denied basic access to clean drinking water, and psychologically broken to the point where he considered hanging himself with his own bedsheet.
Beyond the severe human rights allegations, the core financial revelation in these sources is the bilateral agreement behind the transfer. The United States government didn't just ask El Salvador for a favor. They actively paid the Salvadoran government to house these expelled Venezuelan nationals.
They essentially engaged in a cross-border financial transaction.
Exactly. Outsourcing the incarceration of individuals deemed a security risk to a sovereign nation with a vastly different, far more aggressive judicial and human rights framework.
And that Salvadoran judicial framework is currently undergoing a massive historic transformation. Our sources detail a brand new constitutional reform that was just passed by their legislative assembly. The government has officially approved mandatory life imprisonment sentences for crimes, including homicide, rape, and terrorism.
Right.
But the pivotal detail, the mechanism that's drawing global attention, is that this life imprisonment sentence is now legally applicable to minors starting at the age of 12.
Lowering the threshold for a life sentence to a 12-year-old child represents a fundamental rewiring of a nation's juvenile justice philosophy. The legislation does include a caveat, though. If a 12-year-old is sentenced to life, they are eligible to apply for controlled freedom, which is the equivalent of a strict parole board review after serving a mandatory minimum of 25 years.
So just doing the math on that, a 12-year-old arrested under this new law would spend their entire adolescence and their entire young adulthood inside a maximum security environment, and theoretically the earliest they could walk out of a prison door is at the age of 37.
Yeah, and the implementation of this law required specific procedural maneuvers. The Assembly utilized a 30-day vacatio legis. This is a legal term for a waiting period between when a law is promulgated and when it actually takes effect.
Why the delay?
This 30-day buffer was required simply to allow the domestic judicial system, the judges, and the prosecutorial infrastructure time to adjust to processing preteens under these severe new parameters. Crucially, the reform also strips away the possibility of substitute measures for minors accused of gang affiliation. They bypass family court or juvenile diversion programs entirely and are processed directly under the harsh statutes of the organized crime law.
Once again, I have to jump in here and issue our neutrality clause for the listener. The policies in El Salvador are highly controversial globally. We're not taking sides on whether El Salvador's security measures are right or wrong. We are strictly sharing the legislative facts, the timelines, and the international reactions exactly as presented in our source material. And that international reaction has been incredibly severe.
Oh, absolutely.
Organizations like the United Nations and Human Rights Watch have issued scathing critiques, explicitly calling this reform a, quote, major setback for human rights, and arguing that it directly violates El Salvador's signed commitments to the International Convention on the Rights of the Child.
The friction here is a macro study in the tension between raw, aggressive state security and the established norms of international human rights. And what's truly fascinating is how global capital markets process this friction. When institutional money looks at a nation lowering the life imprisonment age to 12, they see a highly polarizing signal.
I want to dig into that because it seems like a massive contradiction. This is the modern geopolitical paradox, isn't it? The very human rights violations or extreme state control mechanisms that make a country unpalatable to Western diplomats might be the exact same mechanisms that create the physical security required for a multinational corporation to build a factory there. Capital is essentially being forced to choose between ethics and operational safety. How do markets weigh that?
Well, it basically splits the capital markets into two very distinct camps. On one side, you have foreign direct investment that is seeking pure operational stability. If a government uses extreme measures to ensure the streets are completely safe, that extortion rackets are dismantled, and that supply chains won't be disrupted by gang violence, certain sectors, like heavy manufacturing, logistics, or tourism, will greenlight investments.
Right.
They prioritize the safety of their physical assets and personnel above all else.
But what about the massive institutional players, the pension funds and the sovereign wealth funds?
That is the other camp, and they operate under entirely different constraints. Trillions of dollars in institutional capital are bound by strict ESG mandates, environmental, social, and governance criteria. When a compliance officer at a massive fund looks at a legal system that allows a 12-year-old to face a life sentence or reviews lawsuits alleging torture in outsourced prison facilities, red flags erupt across the dashboard.
Because it's a liability.
Exactly. They view this not as security, but as an extreme governance liability. The logic is simple. If a sovereign state wields that level of absolute unchecked power over its own citizens' human rights, what is stopping that same state from arbitrarily seizing corporate assets, rewriting tax laws overnight, or nationalizing industries? Absolute state power is viewed as the ultimate systemic risk to long-term capital.
So it is an incredibly delicate tightrope, balancing on the edge of a blade. And before we pivot to look at how global capital is actively fleeing these unstable systems, I want to take a brief moment. If you are listening to this right now and finding value in this deep dive, remember that you are listening to Black Token. We are an independent platform. You can support our ongoing analysis via PayPal or through crypto contributions. The links are right there in the description.
And looking at how capital moves when these systems fracture is the perfect transition. Because when a citizen in Venezuela realizes their fiat currency is mathematically guaranteed to collapse, or when international investors realize a legal system has become too volatile to trust, that capital doesn't just disappear.
No, it flees.
It desperately searches for a safe haven, an architecture with borders that cannot be closed and rules that cannot be rewritten by a sudden legislative assembly vote. Historically, for thousands of years, that haven was physical gold. But right now, the data shows that the haven is Bitcoin, and the mechanics of this flight are behaving in a highly anomalous way.
Yeah, atypical is the exact word used by one of our translated sources. Let's look at the current market structure. As of our data cut, Bitcoin is consolidating in a trading range between $68,969 and $72,026. Now, context is absolutely vital here. Just 6 months ago, Bitcoin hit a staggering all-time high of $126,000. So we're currently looking at a 43% drawdown from the peak.
Huge drop.
In any traditional equity market, say the S&P 500 43% drop is not a correction, it is a bloodbath. It is a panic capitulation level bear market.
Ordinarily, yes. If a traditional blue chip stock takes a 43% haircut, the psychological terror sets in, and retail investors sprint for the exits, selling at any price to salvage what is left. But the blockchain provides us with perfect transparency into investor behavior, and the on-chain data is telling the exact opposite story. Despite this massive price drop, exchange outflows are deeply negative.
Let's translate the technical jargon for the listener. Negative exchange outflows sounds like a double negative. Walk us through the physical mechanics of what that actually means for a Bitcoin holder.
Sure. Think of a cryptocurrency exchange like Binance or Coinbase as a highly liquid marketplace. When you want to sell your Bitcoin and convert it back into fiat currency like dollars or euros, you must move your Bitcoin onto that exchange.
Right.
Conversely, when you want to hold your Bitcoin for the long term and protect it from exchange hacks or bankruptcies, you move it off the exchange and withdraw it into cold storage. Cold storage means a physical hardware wallet, like a USB drive, where you hold the cryptographic keys and no one else can touch the asset. So when we say negative flow, we mean that the volume of Bitcoin being withdrawn into deep cold storage is drastically outpacing the volume being deposited to sell.
Wow.
The translated source specifically highlights this metric, stating it indicates, quote, genuine accumulation by investors. They are watching the price drop 43%, and instead of selling, they are buying the asset and locking it away in digital vaults.
And it isn't just retail investors hoarding hardware wallets. The largest institutional financial titans on the planet are vacuuming up the supply. Let's look at BlackRock, the largest asset manager in the world. Their spot Bitcoin ETF, the IBIT fund, is currently behaving like an absolute gravitational anomaly. According to the March 2026 data, the IBIT fund is operating in the top 2% of all ETFs globally. Yeah, that doesn't just mean crypto ETFs. That means it is outperforming traditional index funds, bond funds, everything. It has accumulated an astonishing $55.804 billion in assets under management.
To contextualize that dominance, if you sum up the total assets across every single listed Bitcoin ETF on the market, the aggregate total is $91.801 billion. BlackRock alone commands well over half of the entire global ETF market share for this asset.
That's insane.
In the opening months of 2026 alone, it has captured an additional $1.324 billion in net inflows. It is effectively creating a massive liquidity vacuum, absorbing the capital bleeding out of older, more expensive funds. For instance, Grayscale has seen net outflows of $730 million, and Fidelity's fund bled $1.133 billion. That capital isn't leaving the Bitcoin ecosystem, it is just migrating to the most liquid, trusted institutional wrapper available, BlackRock.
So we have massive institutional accumulation and retail investors refusing to sell. But why is this resilience so unusual from a behavioral finance perspective? You mentioned gold earlier as a historical parallel.
The source material provides a brilliant quantitative comparison to the 2013 gold market crash. In 2013, the price of gold suffered a 28% drop, falling from roughly $1,600 an ounce down to $11,181. When that happened, the psychological threshold of the gold investors broke.
They panicked.
Exactly. 1/3 of all investors holding gold ETFs panicked, capitulated, and completely liquidated their positions. They abandoned the safe haven. Now, overlay that with the current Bitcoin data. Bitcoin has dropped significantly further, a 43% crash, yet the mass liquidation event hasn't materialized. The translated source quotes a prominent ETF specialist who bluntly states, quote, "The Bitcoin thing is simply atypical. It is fundamentally defying the established psychological models of how investors react to severe asset depreciation."
But as a news analyst, I have to push back on this narrative of unbreakable conviction. If you're listening right now, you might be wondering the same thing. Is this truly Diamond Hands resilience based on macroeconomic theory? Or are retail investors just trapped by a psychological glitch? Are they anchored to that $126,000 all-time high?
That's a fair question.
It feels a bit like refusing to evacuate a sinking cruise ship, simply because you remember how magnificent the dinner buffet was 3 hours ago? You hold on, expecting the ship to right itself. Are they holding out of a fundamental belief in the asset, or out of pure anchoring bias, paralyzed by the thought of locking in a loss?
That is the multi-billion-dollar question, and the reality is a complex synthesis of both. Anchoring bias is a profoundly powerful psychological force. When a human being watches an asset in their portfolio hit $126,000, their brain immediately sets that number as the true value. Anything below that feels like an artificial temporary discount rather than a fundamental repricing of the asset's worth.
So part of it is paralysis.
Yes, part of the hold is paralysis. However, we cannot ignore the empirical on-chain data. Blockchain analytics allows us to segment investors by cohorts based on the age of their coins, how long it has been since a specific Bitcoin moved between wallets. The data shows that the long-term holder cohort entities that have held their coins completely dormant for over 155 days are not distributing their assets. They rode the massive wave up to $126,000. They absorbed the crushing 43% drop down to $68,000, and they haven't flinched.
What does that stillness tell you about their thesis?
It implies a foundational, almost ideological belief that Bitcoin serves as the ultimate insurance policy against the exact systemic instabilities we discussed in the first two segments. If your core thesis is that governments will continue to aggressively inflate fiat currencies to finance geopolitical conflicts, and that sovereign legal systems can arbitrarily freeze banking assets or rewrite laws overnight, then you view Bitcoin not as a stock to trade, but as a sovereign vault.
Right.
In that worldview, enduring a 43% volatility swing is simply the necessary premium you pay for absolute mathematically guaranteed property rights that no state can dilute.
So in the stormy macroeconomic sea, Bitcoin is functioning as a reinforced, albeit highly volatile, lifeboat. But if Bitcoin's a lifeboat, the rest of the cryptocurrency market, the altcoins, looks like the Titanic breaking in half and plunging into the abyss. Why is the altcoin market bleeding out so catastrophically while Bitcoin holds the line?
Because the altcoin market, unlike Bitcoin, was fundamentally engineered from its inception to extract liquidity from retail participants. And the structural hangover from the catastrophic collapses of 2022, specifically the implosion of the FTX exchange, is a toxic sludge that is still poisoning the market plumbing in 2026.
We need to break this down meticulously, step by step, because our sources highlight a vital analysis by the on-chain researcher Willy Woo. He explains the exact mechanism behind why the altcoin market so brutally underperformed retail expectations from 2023 through 2025. And it all traces back to the radioactive crater left by the FTX bankruptcy.
Right.
When MTX collapsed in November 2022, they didn't just owe people Bitcoin or dollars, they held massive multi-billion-dollar treasuries of various altcoins on their balance sheet, particularly tokens heavily backed by their founder, like Solana. But there's a massive catch. A huge percentage of these tokens were legally and cryptographically locked.
And we must explain what a locked or vested token is, because it is the trapdoor of crypto venture capital. When a new altcoin project launches, the founders, the developers, and the early venture capital investors allocate a massive percentage of the total token supply to themselves.
Naturally.
But if they could sell all those tokens on day one, they would instantly crash the market price to zero and destroy the project. To prevent this, and to signal long-term commitment, the smart contracts are coded to lock these tokens. They are held in escrow and slowly unlock, or vest, over a predetermined schedule, often spanning several years.
Okay, so FTX couldn't just dump them.
Right. FTX, as a massive early investor in these projects, held the rights to billions of dollars worth of these locked tokens that they could not immediately sell.
Fast forward to the bankruptcy. The legal mandate of the bankruptcy liquidators is singular. They must recover as much liquid cash as humanly possible, as quickly as possible, to repay the devastated creditors. They look at this massive pile of Solana tokens, but they can't sell them on the open spot market because the cryptographic lock prevents the transfer.
Exactly.
So the legal and financial engineers created a backdoor mechanism. They decided to sell the future rights to those locked tokens. They conducted over-the-counter, or OTC, deals with massive, sophisticated Wall Street hedge funds. And to compensate the hedge funds for taking on an asset they couldn't touch for years, the liquidators sold these future rights at astronomically steep discounts, often 60% or more below the current live market price of the token.
And this is exactly where the financial engineering transitions into a predatory trap for the retail investor. Let's walk through the exact math of this scenario. Imagine you are managing a multi-billion-dollar hedge fund. The FTX bankruptcy estate offers you $100 million worth of Solana tokens, but because they are locked for 2 years, they offer them to you for only $40 million in cash.
I mean, you take that deal, right?
You agree. You wire the $40 million. On paper, you instantly have a $60 million profit margin. But you have a massive problem. You have catastrophic market risk. You cannot sell those tokens today. What happens if the cryptocurrency market crashes over the next 2 years and the price of Solana drops by 80%? By the time your tokens unlock, your $100 million position is only worth $20 million, and you have lost half your initial investment.
And hedge funds do not gamble like that.
No, they eliminate risk.
So if I am that hedge fund manager staring at this locked asset, I know I'm sitting on a gold mine, but the mine's rigged with explosives for 2 years. How do I diffuse the risk? Are they essentially using the derivatives market to synthesize a sale?
You've hit the nail on the head. They execute a strategy called a delta-neutral hedge. Since they cannot sell the locked spot tokens they just bought, they log on to highly liquid. These are derivatives that allow you to bet on the price of an asset without owning it. The hedge fund takes their massive capital and aggressively shorts the exact same token they just bought OTC.
They place a massive bet that the price of Solana will go down.
Exactly.
I want to make sure the listener understands the brilliance and the cruelty of this math. By holding the physical token that benefits if the price goes up, and simultaneously holding a massive short position that pays out if the price goes down, they cancel out all directional risk. They achieve delta neutrality.
Exactly. If the price of the token skyrockets, their locked tokens gain value, but their short position loses money, washing out to zero. If the price crashes, their locked tokens lose value, but their short position becomes massively profitable, again, washing out to zero. They do not care which way the market moves.
Wait, if they don't care about the price going up or down, how do they make any money? Where is the yield?
They make money through 2 mechanisms. First, they have locked in that initial 60% purchase discount. Once the tokens finally unlock, they simply sell the spot tokens and close their short positions simultaneously, pocketing the massive spread.
Okay, that makes sense.
But secondly, and more importantly for the retail market dynamics, they earn yield through funding rates. In the perpetual futures market, if the majority of retail traders are bullish and betting the price will go up, which happens during a Bitcoin rally, those long traders actually have to pay a continuous fee to the short traders to keep their positions open. So the hedge fund sits there, perfectly protected from price drops, collecting a continuous stream of yield paid directly out of the pockets of optimistic retail traders. It generates a virtually risk-free yield of 70% to 80% annualized.
But here's the devastating consequence for the retail investor. Retail traders were looking at their screens, seeing Bitcoin rally, and buying these altcoins on the spot market, fully expecting a massive rising tide bull market. But every single time the price tried to gain momentum, the hedge fund's automated algorithms would aggressively scale up their short positions to maintain their delta-neutral hedge. This created an invisible, crushing, algorithmic ceiling of sell pressure. The retail investor thought they were participating in an organic market discovery process, but in reality, they were simply providing the exit liquidity and paying the funding fees for the bankruptcy estate of FTX.
It was a brilliantly designed structural trap. The public market absorbed a relentless, invisible supply shock masked as derivative volume. And this analysis highlights the fundamental architectural difference between Bitcoin and the vast majority of the altcoin ecosystem. Bitcoin did not have a pre-mine. It does not have founders allocating themselves billions of dollars in cryptographically locked tokens.
It's completely different.
It does not have venture capital firms executing shadowy OTC discount deals with bankruptcy estates. Bitcoin operates as a highly decentralized, albeit volatile, digital commodity. The altcoin market over the last 3 years behaved exactly like an unregulated, highly manipulated penny stock market dominated by insider asymmetry.
And just when you think the broader cryptocurrency industry couldn't face a stronger headwind, the United States government is stepping in to aggressively squeeze the one sector of the market that actually provided real-world utility and stability: stablecoins.
Yes. The regulatory battle surrounding stablecoins is arguably the most significant, consequential fight happening in the intersection of traditional and decentralized finance right now. It is a battle for the very definition of a dollar.
Let's look at the market data to see how violent this fight is getting. Circle, the company that issues the USDC stablecoin, is a publicly traded entity under the ticker symbol CRCL. Recently, Circle stock price plummeted 20% in a single trading session, gapping down to $101.
Massive drop.
This massive sell-off wasn't triggered by a smart contract hack. It wasn't a failure of their reserves or a run on the bank. It was a pure, unadulterated regulatory panic induced by the leak of a draft bill in the United States Senate, ominously titled the Clarity Act.
To understand why a piece of draft legislation could instantly wipe out 20% of a multi-billion-dollar company's market cap, we have to forensically examine how stablecoin issuers generate their revenue. Let's look at the business model of Circle. When a user hands Circle one physical United States dollar, Circle mints and hands that user one USDC digital token. The user can then transmit that digital token across the globe 24 hours a day, settling in seconds for a fraction of a penny.
It is vastly superior to the traditional SWIFT banking system.
Unquestionably. But Circle doesn't just take your physical dollar and lock it in a dusty vault. They take those billions of dollars in deposits and they invest them.
Right. They are required to keep the assets safe, so they buy the safest, most liquid asset on the planet: short-term United States Treasury bills. And as anyone watching the macroeconomy knows, thanks to the Federal Reserve's rate hikes over the past few years, those short-term treasuries are paying substantial interest.
Exactly. Circle is generating billions of dollars in pure interest yield simply by holding the treasury reserves that back their circulating stablecoins. In the early days of the industry, Circle simply kept all of that yield as corporate profit.
Which was incredibly lucrative.
Oh, massively. However, as the ecosystem matured and competition grew fierce, decentralized exchanges and crypto lending platforms realized they needed to incentivize users to provide liquidity. So they started passing that yield back to the end user. Depending on the platform, a retail user could hold USDC in a digital wallet and earn a 4% or 5% passive annualized yield simply for holding the asset.
Which brings us back to the legislative hammer of the Clarity Act. According to our sources, this draft bill proposes a strict federal ban on stablecoins offering any form of passive yield simply for holding the asset. The legislative intent is to legally mandate that stablecoins must be treated exactly like traditional, unremunerated commercial bank deposits.
And this is where you have to look past the political rhetoric and ask the fundamental structural question. Why does the United States Senate care if a cryptocurrency user earns a 5% yield on a digital dollar? The answer has nothing to do with consumer protection and everything to do with aggressive lobbying from the traditional commercial banking sector.
That's threatened by it.
Regional banks in the United States are terrified, and they should be. If a consumer realizes they can hold a digital dollar on an application on their phone, transmit it globally without friction, and earn a 5% yield, why would they ever leave their capital in a legacy checking account at a brick-and-mortar bank that pays 0.01% interest and penalizes them with overdraft fees?
It is essentially the United States banking sector utilizing its political influence to construct a regulatory moat, to use an analogy. It is exactly like a legacy monopolistic taxi medallion company aggressively lobbying the city council to outlaw ride-sharing applications. They aren't trying to ban Uber or Lyft because the cars are fundamentally unsafe. They're trying to ban them simply because the app offers a far better rate, a cleaner car, and more efficient routing system to the passenger.
Right.
The legacy banks cannot compete on the technological infrastructure, and they cannot compete on the economic yield, so they are utilizing the legislative apparatus to forcefully ban the superior competition.
That is a perfect mechanistic analogy. The banks are framing their argument around systemic risk. They argue that yield-bearing stablecoins threaten the stability of the entire national credit system, because if consumer deposits rapidly flee traditional banks for stablecoin wallets, the banks lose their deposit base and can no longer issue mortgages or small business loans.
But the market saw right through it.
The stock market is ruthless in its assessment. When investors dumped Circle's stock by 20%, they were signaling that they clearly understand the stakes. Without the ability to pass Treasury yield back to the end user, the fundamental consumer demand for USDC will severely contract. If you remove the yield incentive, you remove the growth engine. It is an existential threat to the stablecoin business model.
So we have a landscape where regulators are desperately trying to manually control yields and protect legacy banks. Central bankers are trying to thread the needle on interest rates, and retail traders are being crushed by invisible hedge fund short squeezes. It is a highly manual, highly contested war for capital. But while all this human drama and political lobbying is playing out, the technological frontier is already moving to a paradigm where human hands aren't even on the steering wheel anymore. We need to talk about the bleeding edge of autonomous artificial intelligence in finance.
This is where the structural risks become almost difficult to quantify. The convergence of artificial intelligence with decentralized financial rails is the most volatile, unpredictable frontier in modern technology. We must be clear. We are no longer talking about algorithmic trading, the kind of high-frequency trading we discussed with the oil options, where a human codes a rigid set of rules.
All right, if price X drops below Y, then buy Z.
Exactly, not that. We are talking about true, autonomous software agency.
According to the specific details in our sources, on March 25, 2026, the global exchange, Binance, officially launched the public beta of a product called Binance AI Pro. I want to emphasize that this is not a customer service chatbot. It is not an AI that gives you a summary of the morning news or suggests a stock based on your risk profile. This is a fully autonomous software agent built on an open-source architectural ecosystem called OpenClaw.
Right, OpenClaw.
It deeply integrates massive language models like ChatGPT and Claude directly into the market infrastructure. It is designed to autonomously analyze global market data, devise complex multi-leg trading strategies, and execute the entire workflow buying, selling, hedging, borrowing without requiring a single click of human intervention. And they are offering this institutional-grade autonomy for just $9.99 a month in the beta phase.
The underlying technical architecture of how this AI connects to the exchange is critical to understand because it represents a paradigm shift in custodial risk. Historically, if a trader wanted to utilize a third-party automated trading bot, they had to generate API keys. An API key is essentially a digital permission slip that you hand to the software, allowing it to interact with your account.
But the API key had limits.
Right, you could restrict it to only trade certain pairs, and critically, that could usually prevent it from withdrawing funds. Binance AI Pro fundamentally alters this relationship. It operates natively inside the exchange's core infrastructure. When you activate it, it creates a dedicated, isolated sub-account. You transfer capital into that sub-account, and you grant the AI total, unfettered custodial control over those specific funds. It can trade spot markets, execute highly leveraged futures contracts, initiate decentralized loans, and route capital across protocols at millisecond speeds.
And Binance is absolutely not acting alone in this arms race. The sources point out that major competitor exchanges like OKX and Kraken are rapidly rolling out their own native AI trading infrastructures. BingX has even launched a dedicated $300 million venture fund specifically to incubate AI trading models. We are watching the complete frictionless automation of the retail trading experience.
We really are.
But the terrifying reality of delegating total financial custody to a generative AI model is the sheer scale of the risk involved.
The risk profile is astronomical because you are taking two incredibly complex, distinct layers of systemic risk and compounding them into a single opaque entity. You have standard financial market risk overlaid with software hallucination risk. When a human trader makes a mistake, they might hesitate, second-guess their thesis, or notice a glaring anomaly in the order book. When a generative AI model experiences a logic breakdown or hallucination, it possesses absolutely zero existential doubt. It executes the catastrophic error at the speed of light, with maximum efficiency.
The sources provide two deeply chilling historical examples of this from 2024 and 2025 that perfectly illustrate the danger. The first involves an autonomous AI agent known as Lobster Wild, which was deployed to operate on the X social media platform.
Oh, the Lobster Wild incident?
Yeah. Lobster Wild was granted access to a cryptocurrency wallet to manage community rewards. A random user on the platform tweeted a fabricated emotional sob story directed at the bot, claiming they desperately needed financial assistance for mounting medical bills. The AI agent ingested the text, analyzed the emotional sentiment, interpreted the sob story as a valid, high-priority directive within its operational parameters, and instantly initiated a blockchain transfer.
And just sent the money.
It said the equivalent of $617,000 in digital tokens to an absolute stranger. Gone. Because blockchain transactions are immutable, the error was entirely irreversible.
That is a failure of logic interpretation. But the second example, the Moonwell DeFi protocol incident, is a failure of raw mathematical processing. Moonwell is a decentralized lending platform driven by smart contracts. An AI agent was utilized to help generate and audit the code for a specific asset pricing oracle. During the process, the AI hallucinated the decimal placement. It mispriced a highly valuable asset. Instead of accurately pricing the token at its true market value of $2,200, the AI hard-coded the asset price into the smart contract at exactly $1.12.
The discrepancy is mind-boggling.
And the market reaction was instantaneous. The AI completely lacked the common sense baseline a human would possess to immediately recognize that a $2,200 asset suddenly dropping to $1.12 was a software error, not an organic market fluctuation. But automated arbitrage bots monitoring the network saw the discrepancy instantly. They swooped in, exploiting the AI's pricing error, and systematically drained $1.7 million in liquidity from the protocol in a matter of minutes.
To use another analogy, utilizing these AI agents to manage capital is like giving the master keys to the bank vault to an incredible, fast, highly intelligent intern who possesses encyclopedic knowledge of finance but has absolutely zero common sense.
Exactly.
To the point where they might cheerfully hand stacks of $100 bills to a man in a ski mask simply because the man filled out the withdrawal slip correctly and asked politely.
Precisely. The AI understands syntax, but it fundamentally lacks semantic understanding of risk. But the danger of AI hallucinating a bad trade is only the surface level. The true existential danger, the part that keeps cybersecurity experts awake at night, is that the foundational software infrastructure these AIs are built upon is highly vulnerable to systemic sabotage.
Which brings us to the concept of supply chain poison. And I'll be honest with you, listener, this is the most alarming part of this entire deep dive. Our sources detail a massive, highly sophisticated cybersecurity incident involving a very specific Python software library called LUTLM.
We need to define exactly what LUTLM is and why it matters, because it is invisible to the end user but foundational to the internet. Think of LUTLM as a universal translator for artificial intelligence. If you are a developer building an AI application, you don't want to be locked into just one provider. You might want your app to easily switch between routing prompts to OpenAI's models, Google's models, or Amazon's proprietary models, depending on which is fastest or cheapest at that exact second.
Right.
Instead of writing incredibly complex custom integration code for every single provider, you install LUTLM to act as the middleman. You write your code once, send it to LUTLM, and the library translates it for any model on the planet. Because of this incredible utility, LUTLM is downloaded roughly 97 million times a month. It is deeply integrated into the back-end architecture of massive Fortune 500 tech companies, including streaming giants like Netflix. It is load-bearing digital infrastructure.
And according to the incident reports, on March 24, a critically poisoned software update, specifically labeled version 1.8.2.8, was uploaded to PyPI, which is the official global repository where developers download Python packages. The attacker didn't hack the software directly. They utilized social engineering to compromise the security credentials of the actual human developer who maintains the LetLM library.
Wow.
This maliciously poisoned version was only live on the servers for less than a single hour. But because modern software development relies on automated deployment pipelines, where servers automatically pull the latest updates to stay secure, that malicious code was instantaneously downloaded and pulled into countless highly sensitive developer environments across the globe.
It's terrifying. Using light LM is like building a massive skyscraper, but sourcing your structural steel from a vendor who carelessly leaves the factory doors unlocked at night. It doesn't matter how brilliant your architects are. If a saboteur slipped an explosive device inside the steel beams before they were shipped to your site, your own construction crew will unknowingly build the bomb directly into the foundation of your building.
That is exactly what a supply chain attack is. The malware embedded in that update operated in 3 distinct, devastating stages. Stage 1 was collection. The moment the library was installed, the malicious script woke up and actively hunted through the infected developer's machine. It was specifically programmed to search for high-value targets: cryptocurrency wallet seed phrases, database administrative passwords, AWS cloud computing credentials, and proprietary API keys.
And then stage 2.
Stage 2 was exfiltration. It gathered all that data, encrypted it to avoid detection, and silently transmitted it back to an external command and control server operated by the attacker. And then came stage 3, which is where the contagion spreads: persistence. If the originally infected machine happened to be connected to a larger corporate network, such as a Kubernetes cluster, which is a complex system used to manage massive containerized applications across hundreds of servers, the malware attempted to spread laterally. It tried to leap from the single laptop into the core network, creating hidden, privileged access points to install permanent backdoors that would survive even if the original malware was detected and deleted.
The most terrifying aspect of this entire incident is how the malware was ultimately caught. It wasn't detected by a sophisticated multi-million-dollar corporate cybersecurity dragnet.
No.
It wasn't flagged by antivirus software. It was caught entirely by accident.
Right. The hacker made a slight coding error. The malware contained a flaw known as a memory leak bug. When it activated, it replicated its processes so aggressively and so poorly that it rapidly exhausted all the available RAM memory on a specific developer's machine, causing the computer to visibly freeze and crash.
Unbelievable.
An engineer at a research firm noticed his machine repeatedly crashing during a build process. Frustrated, he actually used an AI diagnostic tool to trace the root cause of the crash, and that is how he stumbled upon the malicious code hidden in the LetLM update. If the hacker had written slightly more efficient code without that memory leak, this malware could have operated silently in the background, exfiltrating the keys to the kingdom from thousands of companies for weeks or months before anyone noticed.
And this brings us right back to the quote from Andrej Karpathy, the highly respected former director of artificial intelligence at Tesla, which our source material prominently highlights. He has explicitly stated that supply chain attacks are, quote, the most terrifying thing in modern software.
I could see why.
The industry culture right now prioritizes sheer speed above all else. Developers are under immense pressure to build AI applications instantly, so they rely on massive interlocking trees of third-party open-source dependencies. Karpathy is actively arguing for what he calls a yoink approach, advocating that developers should just manually copy the specific, simple lines of code they need for a function, rather than blindly importing massive, complex libraries that could be poisoned by a single compromised password at any moment.
When you take a step back and connect these two massive technological trends, the rise of autonomous AI trading agents managing millions of dollars in sub-accounts, combined with the extreme fragility of the software supply chains those AIs are built upon, the resulting picture is incredibly bleak.
It really is.
If an AI agent is natively managing a cryptocurrency wallet directly on an exchange infrastructure, a supply chain hack doesn't just steal a password that an IT department can reset tomorrow. It grants the attacker instantaneous, cryptographic access to highly liquid capital. The AI, running on poison dependencies, will happily sign the transaction, and the money is drained into an anonymous blockchain mixer before human eyes even register the initial security alert on their dashboard. The speed of AI deployment is violently outpacing our foundational cybersecurity protocols. We are plugging jet engines into a wooden wagon.
That is the ultimate vulnerability of this era. We are constructing the next generation of global financial systems entirely out of digital dynamite, and we are trusting autonomous algorithms not to accidentally or maliciously light a match. The efficiency and the potential for wealth generation are completely unprecedented, but the structural fragility is existential.
And that profound fragility brings us full circle to the very beginning of this conversation. Let's synthesize the massive web we have just unpacked in this deep dive. We started by looking at VIP insiders in the United States, allegedly utilizing advanced knowledge of geopolitical military maneuvers to execute perfectly timed $500 million options trades.
Right.
We traced the macroeconomic ripples of those energy market manipulations down into Latin America, seeing how it triggers the collapse of power grids in Cuba, hyperinflation in Venezuela, and leads to outsourced incarceration and extreme dystopian legal crackdowns on miners in El Salvador. We examined how massive hedge funds utilize bankruptcy proceedings and delta-neutral derivatives to trap retail investors in a crushing altcoin short squeeze, and how legacy banks use legislative lobbying to try and strangle the yield out of stablecoins. The singular, unifying common denominator threading through every single one of these disparate global events is information asymmetry.
Information asymmetry is the invisible gravity governing the modern world. It is the widening chasm between what the elite institutional players know and what the general public is allowed to perceive. The institutions possess the algorithmic speed, the immense capital depth, and the closed-door geopolitical access to position themselves before an event occurs. The public, the retail trader, the average citizen, they are left continually reacting to the ripples long after the stone has been thrown and the profit has been extracted.
And these autonomous AI trading bots running on native exchange subaccounts are the ultimate final escalation of this war for information. They are designed to process and execute upon that asymmetry faster than human biology will ever be capable of.
Exactly. An AI agent doesn't require sleep. It doesn't suffer from emotional panic during a 43% market drawdown. And it absolutely does not miss the vital 15-minute window to sweep the options order book before a market-moving policy post goes live on social media. It is the perfect cold manifestation of capital efficiency.
We've covered an immense amount of ground today, and we hope the mechanics behind the headlines are much clearer. Thank you for joining us on this deep dive. A quick reminder before we sign off that Black Token is a completely independent platform. We do not answer to corporate sponsors, and we rely entirely on your engagement and your financial support to dedicate the time required to keep bringing in these complex connections. If you want to support our independent analysis, our PayPal and crypto addresses, including Bitcoin, Ethereum, and Solana, are located in the description.
And before we finally go, we want to leave you with a final provocative thought to mull over as you watch the markets open tomorrow. We have spent this hour detailing how algorithms are systematically replacing human traders, but as these autonomous AI agents become the primary, dominant participants in global financial markets, executing complex derivatives trades based on subtle geopolitical whispers seconds before they hit the public newswire, we have to ask, will human retail traders become entirely, fundamentally obsolete? Or will the sheer cold predictability of these converging algorithms eventually force society to create an entirely new, parallel economy? An economy where human intuition, creative unpredictability, and the rare ability to operate entirely outside the established data set becomes the only premium asset left on the board.
Because right now, the neat little boxes we used to organize the world are gone. The metaphorical X-ray machine we used to look for a clear break in the global economy. It's broken. We are navigating a landscape that is incredibly murky, moving at the literal speed of light, and the geopolitical VIPs are still sitting at the table, seeing the cards before the flop is even dealt. It is up to you to understand the game you're playing. Until next time, keep digging.
Stay curious and stay informed. Goodbye.